Welcome to your next edition of Highlights, and we're going to be focusing now on one of my favorite Western technical techniques called Change of Polarity, and we'll be looking at a Forex market, but just to remind you, whatever education you get from us, you could use in all markets and all time frames. So let's look at the Change of Polarity. So a multi-tested support area, once broken, becomes potential resistance. Let me show you why. Imagine buying here or here or even here or here, and you're happy, you bought near a support area because you saw the last two times it got down to these levels, it bounced, and then the market does this. Okay, congratulations, you bought a support. You're not very happy now because now you're losing money. So whoever bought in these zones here would be thrilled to break even by becoming sellers. In other words, getting out of their long positions where they were losing money as the market moved down. Okay, so the prior support becomes resistance. So essentially, this is what happens. The market breaks support. Those buyers near the support area just pray, in lots of languages, that the market rallies so they could be selling at break even. Now, the change of polarity also works with breakouts. So I have a multi-tested resistance area. Once the market breaks out, the resistance should become support. So here's the change of polarity with the downside break, where old support becomes resistance. And here it's an upside breakout where the prior multi-tested. It's important. It's not just the resistance area tested once. It should be tested at least twice for the change of polarity to work. And let me show you a recent example here in the pound dollar. So here we have a zone of resistance, and I use a zone if the resistance area is very close to one another. So here you're looking at about 50 pips between these highs here and the highs over here, which also incorporates highs here. So once the market broke above it, if the market was valid on any corrections, this prior support should become resistance. Now, one of the ways to do this is, notice we didn't get a confirmation of a breakout until the close all the way up here. And if you did that, assuming you use a stop under here as a stop out level, the risk reward is awful, right? The market moved up too far too fast. So you could say to yourself, hey, if the market gets anywhere near this prior resistance, i.e. new support, one could think about buying it. And so right near that support area, we had a bullish engulfing pattern. Then we had a successful test of the support again back in early June. And if you had bought here, you're looking at about a 400 pip profit potential. And if you bought in the zone here, especially on this one, which was a successful test of the support of the lows over here, give or take a few pips, your target could have been between the high of the doji to the high here, this bearish engulfing pattern. And we're currently in that zone over here. So one of the ways you could use this strategy also is if the market breaks out, you become bullish on a breakout, you could say this old resistance area should be a protective stop, because if the market gets under there, that's a break of this change of polarity support area. So thanks for joining me.